All right, welcome everyone to today's webinar. It looks like we've got a couple people still logging in here, but we're going to go ahead and get started because it is 1 p.m. Today's topic is use it or lose it, the countdown to year-end planning. It began actually for us tax preparers about 2 months ago. Once the fourth quarter approaches, as soon as October 15th rolls by and we close out 2021's filing season, we enter into a really important time. In fact, in my opinion, probably the most important time of the year, which is the wind down time of the calendar year end. So right now at Robert Hall and Associates, we're doing about 9 to 10 appointments a day amongst all of our senior preparers, helping our clients dial in those year-to-date income figures and year-to-date expenses, and hopefully come up with a creative solution to help retain as much of those earnings that you've built for yourself over the past 365 days, as at least retain as much of that as possible. To you, the general tax-paying citizen of the United States, what you think that we do is just help you save tax, and that is true. Hands down, that is true. We help people shelter income and save tax, but most importantly, we help people retain wealth. Which is one and the same. Tax savings and wealth retention, in my opinion, is one and the same. But maybe if we started thinking about tax planning in the way of wealth retention or strategies to help retain wealth, maybe tax planning might be something that you look forward to instead of feel like it's the final exam right before the end of the year that you have to prep for. My name's Tony Watson. I work for Robert Hall and Associates. I've been going on 2 decades with the firm. I service well over 1,200 files per year individually, as my just in my column alone. We've got 13 or 14 senior preparers here on staff with Robert Hall. In my clientele column, I think I'm in the $500+ million range in managed real estate and other business dealings. So I see a lot personally. Our firm sees a lot. I am also the keynote speaker for Robert Hall and Associates, and we right now are averaging about 140 free educational webinars and seminars on a year-to-year basis. So check us out online, roberthalltaxes.com. There's a webinars tab at the top part of our webpage. Click on that to look for future events. And once again, all of our education is free. Aside from just myself here at Robert Hall, I am by no means a one-man operation. We've got a wonderful senior accounting staff, a wonderful administrative staff. We do service tax filings in all 50 states. So if you have investments outside of California, we can assist with those filings as well. Robert Hall and Associates have been around since 1971. So we're not, a pop-up shop here in the Southern California area. We've been around for quite some time. And I'd say that our firm as a whole across the U.S., and we do have foreign clients as well. We don't have a ton of them, but we do see foreign investors coming here with money to invest here in the U.S., and so they have reporting requirements. We've been assisting clients with well over $1 billion in real estate operations and management and wholesaling. So like I mentioned, we do see a lot here at Robert Hall and Associates. We are kind of a one-stop shop for all of your financial needs. Obviously, our main service is tax preparation, but we do offer business incorporating services, so we can start LLCs, S Corps, C Corps, also advise you on what type of entity might be right for you specifically in your situation. We do internal auditing, financial planning, basically you name it, we've got it. And if we don't do it in-house, we've got great referrals to refer you out to. So without wasting too much more of your time, why do I think year-end planning is important, and why should you think year-end planning is important for yourself? Well, during my appointments, I always ask clients every year, this time kind of rolls around the holidays, and we're starting to talk with clients that we haven't talked to in maybe 3, 4, 5 months, or maybe even since earlier this year during tax season. And I always refresh myself with what their wants and needs are. And so I always ask, well, what do you want to get out of this appointment? I know what I want to get out of this appointment, but what do you, the client, want to get out of this? And some people say, well, I want to figure out a way to avoid any penalties and interest on the back end. I want to dial in my year-to-date income, my year-to-date expenses, figure out what I owe Uncle Sam in whatever state I'm filing in, and figure out a way to prepay that so that I'm not assessed any penalties and interest on the back. And that's probably the number one answer when I ask why, ask of my clients at least, why they think year-end planning is important. The number 2 answer is for positioning reasons. I want to position myself for a greater tax benefit, whether it be figuring out what my year-to-date income is so I can go out and maybe purchase a vehicle for my business, maximize a retirement contribution, a 401k, an IRA contribution, or maybe even to take a look at your real estate portfolio and the investments that you already own and strategize to maybe accelerate some future year, let's say bonus depreciation deductions through a cost segregation analysis of some sort. And if you don't know this terminology, don't worry, we'll talk about that in further detail in a couple minutes. But, some people want to just position themselves before the end of the year to help retain wealth, right? To pay less tax overall to Uncle Sam in the state of California, which is where we're located or whatever state they're filing in. But it's to retain that wealth and not overspend with the governing agencies. Positioning power is really important because I feel like in my industry as a tax preparer, it's all about playing the game. It's all about playing chess with the federal government. And the code lays out a specific set of rules. And if you know how to apply those rules in certain ways, you can help yourself avoid paying excess tax while not evading paying tax, right? Because tax evasion is illegal, proper tax avoidance is not. So through proper year-end planning, in these hour to 2 hour appointments, sometimes they're even longer than that, depending on the size of the file. We want to dial in a strategy to implement prior to December 31st to help avoid paying unnecessary income tax, not evade. So positioning power is really, really a key point in year-end planning. Number three, this is probably the third most common answer, and I think that this applies to all of us, is it's peace of mind, right? We don't like surprises in our industry. We want to figure out what the bottom line estimations as far as federal and state liabilities are concerned. We want to figure out those numbers before year end is even here, right? So when we file the tax return next year for 2022, we already know what the numbers look like, right? So the power behind year-end planning is really not only to help you save tax and to keep more money in your own bank accounts, but it's also to give you peace of mind that there aren't going to be any surprises when you actually get ready to submit your company returns, your individual tax returns, your estate, your gifting tax returns, your nonprofit tax returns, whatever filings you're submitting with the government. We want to make sure that we understand those numbers prior to the end of the calendar year. Back when it seems like, decades ago, which it was, but it seems like a lot further ago when I was in school, the day one of my Business 101 course, my teacher, I remember this like it was yesterday, my teacher, first day of class, hops up on his desk, sits down, really cool guy in a really nice suit. And he says, there are 3 rules in business. Number 1, pay your employees. Number 2, reinvest profits back into infrastructure. So reinvest your profits back into yourself, back into your business, and help you grow. And he said the most important rule out of these 3 is number 3, pay as little tax as possible by exercising rule number 2. And back in college, I didn't really truly grasp the concept behind those comments or those rules. But obviously, 20 years into my career with Robert Hall and Associates as a tax advisor, a tax preparer, somewhat of a financial advisor, that makes more sense now, more so now than ever before. If you reinvest your profit back into your business, the government will allow you to reduce your taxable income dollar for dollar in most cases, and allow you to retain that wealth and pay less tax to Uncle Sam and the state agency. So why not sit down prior to the end of the year, figure out what money you've spent already, and then giving yourself a nice buffer, maybe a month or 2 months prior to the end of the year, to go out and spend some more money or reinvest that money back into your business, and which will help you pay less overall income tax. That's the goal here, is to keep as much money in your bank account as possible. And hey, if you're going to spend it, why not spend it on things that could help you build your business? Because once you send that check off to the IRS and the state agencies, they spend it on whatever they feel is necessary to spend the money on. But we want to make sure that we have control of that money as long as possible. And so year-end planning is a really, really important part of wealth building and retention of wealth. Now, during this year-end planning appointment, we look at something called a W-4 review, where we review your year-to-date income, your year-to-date expenses, and figure out creative ways to help keep a lot of that money, right? So we want to dial in those year-to-date figures. Through this W-4 process, we need our clients to put together a couple pieces of information. We need them to add up 12 months of revenue, and then we needed them to take a good look, not down to the penny, but a good estimation of what they've spent through their business account so far. And we want to come up with that net revenue number as of, let's say today, December 6th. What that gives us is a starting point, because you think, okay, well, I've got my income, I've got my expenses. Okay, is that it? No, well, this is just getting us to the starting point, because once we figure out what that net profit number is, that's where we get to start playing some games as tax preparers. Well, we're going to talk about deferred retirement at the end of the consultation normally, because deferred retirement comes after we figured out what we can write off dollar for dollar as far as expenses are concerned. But that is definitely a key point in the year-end planning consultation. So once we figure out that net revenue bottom line, we tell the clients, hey, listen, if you didn't spend another dime between now and the end of the year, if you didn't have any more revenue coming in between now and December 31st, here are the liability figures. This is what you would owe to the IRS. This is what you would owe to the state of California. So this is a good starting point. This is kind of worst case scenario. But if we go out, or we send our clients back out into the wild to maybe reinvest money back into some new equipment, computer purchases, office furniture purchases, maybe there's some travel expenses towards the end of the year around the holidays that we can capture as deductions through the business, obviously, that will help us further reduce this taxable income and save from overspending with Uncle Sam. So we want to make sure that we come up with that exact dialed in figure as low as we possibly can get it. And then we figure out what is a requirement to be prepaid prior to the end of the year. Well, the federal government requires taxpayers to prepay either 90% of their current year liability or 110% of their previous year's liability, whichever we calculate. And a lot of the self-employed individuals that I do taxes for, like property flippers and real estate investors and real estate professionals who are earning commission income on real estate sales, most of them, I'd say probably 90+% of them, will choose to keep that money in their bank account because of other unique investments that might come across their desk. And some of them choose to prepay one of these two calculated figures. So for those of you who prepay on a quarterly basis, those of you who have quarterly estimated tax payments, if you took all 4 quarter payments and you added those up, that should add up to exactly 110% of the previous year's liability, which is great if your income went up in 2022 versus 2021, right? So if you saw an increase in revenue in 2022 over 2021, yeah, that 110% calculation should be prepaid over a quarterly basis. But let's say, just for argument's sake, that 2022 was a little bit slower of a year compared to 2021. Why would you ever prepay 110% of last year's liability if you're on track to hitting lower revenue for 2022? So this year-end planning, even mid-year planning, is really important, because let's say that you don't owe 110% in estimated tax payments and your revenue is, let's say, 20-30% less year over year from 2021. Well, why would we ever want to make a 4th quarter payment or even a 3rd quarter payment if it wasn't going to be due as liability for 2022? So it's really important for you to sit down with your accountant during year-end planning, but also maybe throughout the year. Connect with your tax advisor and dial in those estimated tax payments, because if you can skip a 2nd, a 3rd, or a 4th quarter payment, that means the money is kept in your bank account. And then obviously you have other unique investment opportunities throughout the year, and you have the liquid cash to make those investments, possibly creating more tax shelters for your business. So this 90-110 calculation is really important to analyze throughout the year, not just at year end. And the federal government, if you don't prepay some of these amounts, yes, they will hit you with interest and penalties for underpayment penalties, estimated tax payment penalties, and then obviously the thing that we all know about, which is interest. But like I said, a couple of my clients, actually a majority of my clients who are real estate investors, they choose to keep their money over the course of a four quarter period because they want their money to invest throughout the year. And if the penalties on the back end for keeping that money in your bank account are roughly, let's say 2.4 to 3%, but your unique investments throughout the year that you're plugging cash into are returning you an ROI of, I don't know, let's throw it out 10, 15, 20%. Obviously, it's worth it to keep your money throughout the year, earning that 10, 15, 20% return on investment, and then pay the 2.4 to 3% penalty on the back end. I'm not telling you to not prepay your taxes. I'm telling you that these are options that you have as investors, as self-employed individuals, to keep control of your money throughout the year, and then put a plan in place to also understand what the penalties and interest might be on the back end. So you could play the game in both ways. It all comes down to proper planning, though. I sit at a computer, 9 hours, 10 hours a day, and I have all of these great calculators. So I have access to this information any day of the week. For you as a self-employed business professional elsewhere in other industries, you don't have access to these tools on a weekly basis, but your accountant does. So please do not be afraid to reach out to your accountants throughout the year and map out plans either in first, second, third, or fourth quarter. I think that planning is important in any part of the year, especially if you have an influx of income, if you have a decline in income, or even if you're staying pretty much at a consistent rate throughout the year. It's always important to plan ahead, so keep that in mind. Now, coming out of these very unique pandemic years, we've seen a number of changes on people's tax filings, but I did want to mention a few tax write-offs that I saw change significantly over the past 2.5 to 3 years during this really strange pandemic period of our lives. The number one deduction I saw change the most during the pandemic and coming out of the pandemic is the expense of marketing and advertising. I've seen people triple and quadruple their spending on marketing and advertising. And the craziest thing about this is that on those returns where I've seen the increase in this deduction, I've also seen a correlation with increased income, meaning that the more money people are plugging into marketing and advertising, the more revenue they are seeing. They're reaching out to larger markets. They're diversifying into different areas of within their state or in other states. I've had some real estate professional clients not only capitalize on investments here in California, but also kind of break down the barrier of California and go elsewhere in the US, acquiring syndication investments elsewhere in the US, maybe even buying single family or multi-unit investments elsewhere in the US, Texas, Florida, Nevada, Wyoming, Delaware, Atlanta, Georgia, big investment opportunities in Atlanta, Georgia. So one thing that I saw that was consistent in the increased revenue clients that I'm seeing right now is the increased expense of marketing and advertising. This is a great dollar for dollar deduction to offset self-employed income. And let's face it, how do you get your name out there? When people were sheltered in place at home during the pandemic and they couldn't go into their offices to work, or they couldn't go and knock on doors to market their business. And even if you did, the doors probably didn't open during the pandemic in most cases, because people were living in fear. It was a crazy time in all of our lives. So what did they do? They developed new websites for themselves. They put a ton of money into mailers. They created new marketing materials, business cards, flyers, you name it. Whatever it was, I saw a correlation between increased expense for marketing and advertising and also increased revenue. And I like this deduction because not only is it a dollar for dollar write-off on your federal tax return, but it's a dollar for dollar write-off on your state return as well. And it offsets dollar for dollar any self-employed income or even rental income that you might have if you own real estate in your investment portfolio. So great overall deduction. The number one expense I saw change the most over the past 2.5 to 3 year period. The number two deduction I saw change compared to marketing and advertising, probably just a close second, is professional supplies and equipment. Think about it. When everybody kind of had to move their office space back into their house from brick and mortar locations, people were realizing that they didn't have the right furniture, office furniture, or comfortable chairs, or a fast enough computer at home to do what they do professionally, but from home now during the pandemic. So we saw a lot of computer purchases, upgraded Wi-Fi or whole house Wi-Fi systems. We saw people buying new stand-up desks for their in-home office, more comfortable chairs, tablets, staplers, you name it. People were buying it because they had to operate from home as opposed to in their offices that they've been in, for the last, couple decades, let's say. I like professional supplies and equipment for a number of reasons. Number one, we have options of how to write these expenses off. Let's say, just for argument's sake, that you've already wiped out all of your income with expenses. And at the moment you've written off, let's say you brought in 50 grand, you wrote off $50,000, so you have no profit this year and you're not paying any tax. Well, if you have a computer purchase and it's going to push you into a loss through your business when you're already not paying tax, why would you want to take that deduction this year? Is there a way to carry forward that deduction into future years and maybe offset income in a year where the income is actually showing a profit rather than a break even or a loss? Well, a computer has the ability to do that. You can either accelerate the computer purchase or even office furniture purchase and take it all in 1 year, or you can depreciate the expense over the lifespan of the asset. A computer, a webinar camera, like the one that I'm using right now, it's a beautiful, I forget what it's called. I think it's a Razer camera. It's a beautiful 4K camera, spent a lot of money on it. I can either choose to take that deduction in this year, or I can spread it out over the equipment's 7-year lifespan. So let's say I didn't need the write-off this year, I can carry it forward and offset future revenue. And let's say 2 years down the line, I start to show profit again, I can take the remaining depreciation amount and accelerate it in a year when I need it. So we have options of how to write these expenses off. Equipment has a 7-year lifespan. Office furniture has a 5-year lifespan. So you have options of how to deduct these things. That's number one reason why I like this deduction. Number two is professional supplies and equipment has one of the lowest risks for audit out of any deduction that you take. Let's face it, how many people do you know in your professional circles who can do what they do day in and day out, professionally speaking, without a computer, without a cell phone, without a desk, without a chair, without a filing cabinet, a shelving unit, a storage unit? These are some of the most common business write-offs that I can think of. And so the government knows this. The government knows that during the pandemic, people had to upgrade their in-home office equipment. And so they're allowing a lot of these deductions to be fully accelerated with less than a 0.0001% chance of audit. Okay. In fact, in 19 years that I've been doing this with Robert, 18 going on 19 years, almost 2 decades with Robert Hall and Associates, I have yet to see an audit on a computer purchase. I've yet to see an audit on a cell phone purchase. I've yet to see an audit on a desk or a chair or a filing cabinet. Sure, there are those unique scenarios where you go out and you spend 15 grand at Restoration Hardware for a desk. I don't know who's spending 15 grand on a desk, but I have seen it on a tax return before. Those very unique deductions, because of the size of the deduction, those might throw up a little bit higher of a risk of audit, but at the end of the day, those are few and far between. I want you to maximize the angle on this deduction as much as possible and make sure that you are not limiting yourself to these deductions simply because they are legitimate deductions. And before I go on to the next three, I want to mention something really quickly. In every deduction that you take, the federal government looks for each write-off to meet 3 requirements, basically for 3 boxes to be checked off. Is the deduction ordinary in business? Is it necessary for you to have this item or this expense to do what you do professionally? So is it ordinary, necessary, and above and beyond anything else, is it legitimate as a write-off? So as long as you meet those 3 requirements, you should be taking this deduction as a dollar-for-dollar adjustment to your income. Over the 19-year career that I've had, I've added a 4th requirement on top of those 3 requirements. Make sure that you're being reasonable with how you're allocating these expenses. Obviously, I have 1 cell phone, but I do have real estate professional clients who have multiple cell phones. They have 1 for business, 1 for personal. So obviously the business cell phone, dollar for dollar tax deductible. Personal cell phone, not a business write-off because that's a personal cell phone, right? I have 1 cell phone, and if I took that cell phone as a 100% write-off against my business income, something that I use for both personal and business use, and the federal government, let's say, steps in and questions that write-off, they're going to say, well, where's your other cell phone that's solely for business, or is this your business cell phone? I'd have to make the argument that, no, I only have 1 cell phone, but I use it mostly for business. Unfortunately, that doesn't fly under the IRS code. They would want you to split that deduction into a personal bucket as well as a business bucket. And so right out the gate, you need to have this conversation with your tax preparer about what is a reasonable allocation of business versus personal. I'm not going to sit here and tell you all that you should use a 70-30 split or a 60-40 split. It is a conversation that I need to have with each individual client to see exactly how much they use items for business use as well as personal use. That same theory applies to car use. Right? If you have 1 vehicle, you cannot claim on your tax return that 1 vehicle that you own is solely used for business. Sure, a vehicle is an ordinary, necessary, and legitimate write-off, but above and beyond anything, we're not being reasonable with the allocation. And I'll tell you something about the in-home office deduction really quick, because I feel like that kind of groups into this kind of professional space that you use for your house inside of your home, which includes the equipment and the supplies. A lot of people fear taking an in-home office write-off. And I'll tell you right now, it's not the actual in-home office that gets people audited, because it is a high-risk audit item on a return, but it's not the form that gets people audited. It's the unreasonable allocation of square footage that people use that throws up flags with the IRS. Let me give you an example. I have 2 clients, let's say, one that lives in the Valley, in Burbank area, and it lives in, let's say, a 4,000 square foot home. And then I have a client who lives downtown in an open kind of lofty area, right, with a bathroom, but it's kind of all living space, no walls. It's the bed and the kitchen and the entertainment area. It's all in one space, right? And let's say that the house in Burbank is 4,000 square feet. The loft in downtown is 1,000 square feet, okay? And as a tax advisor, let's say I'm on a webinar, I tell everybody in this webinar to use 25% of their living space as an office space, right? Just very general 25%. Well, I wouldn't be doing you justice as a tax advisor if I just said everybody should be using 25%, because 25% of 1,000 square foot loft is 250 square feet. Pretty reasonable allocation for office space at that point. 25% of a 4,000 square foot home allocates 1,000 square feet of that home for office use. Well, I work in a brick and mortar building and I have a pretty sizable office, and my office isn't anywhere close to 1,000 square feet. So once again, it's the unreasonable allocation of square footage that throws up the red flags with the IRS. One thing I do want to leave you with before I go on to number 3 here is that you should never be afraid of taking an in-home office deduction. There is a whole 3 to 4 page part of the Internal Revenue Code that states that in-home office deductions are ordinary, necessary, and legitimate. But through a conversation that you should have with your tax advisor, make sure that you're just being reasonable with the allocation. You can take an actual room inside of your house as office space and also the nearest restroom to that room. So when you add up that square footage divided by the total square footage of your home, that should give you the reasonable allocation of in-home office space. But once again, have this conversation with your tax advisor. Do not be afraid of taking that deduction. And if you work with a tax advisor or a tax professional that tells you that you shouldn't write this off out of fear of being audited, you need to work with another tax advisor, to be real honest with you. That whole fear approach is not the right approach from a tax planning and tax preparation standpoint. There are right and wrong ways to go about taking these ordinary, necessary, and legitimate write-offs. So keep that in mind. That's okay. So professional supplies and equipment, number 2. Number 3, and I'm sure that you've all seen this in your professional circles, in your personal world, that car and truck expenses. What a crazy time we are all living in, right? Where we look out the window and we see the car parked in our driveway, and that car right now could be sold for $5,000 more than we originally purchased it for. I mean, whoever thought that vehicles could be appreciating assets? Well, we saw this happen during the pandemic. And I want to say that it might be because of supply chain issues. I think that was the main driving force. But I also think that the tax code had a little bit to do with this. The federal government back in 2018 reinstated something called bonus depreciation rules for business owners who were acquiring work vehicles. Now in 2018, that was reinstated. We'll get to that in a second. In 2020, the first year of the pandemic, the federal government changed a part of the code that allowed us as business owners, as self-employed individuals, to not have to go out and buy a brand new car, but look out the window and see that leased car that's sitting in the driveway. And in 2020, the federal government said, hey, you don't have to go out and buy a new car for the write-off. You can actually buy out the leased vehicle that you currently are driving, converting that asset into a depreciating asset for your business, and get the same write-off benefit as if you went out and bought a brand new car. See, prior to 2020, you actually had to go out and buy a new vehicle. It had to be new to you. It couldn't be the leased vehicle sitting in your driveway, and you couldn't sell it to your business. But now, coming out of the pandemic, you can actually do that. And I think that they changed that because they saw the writing on the wall with the supply chain issues and the lack of automotive, inventory for people here in the United States. So the bonus depreciation rules are really unique, though. If you're not taking mileage or if you're not taking actual auto costs as a write-off and you're looking to either buy out a leased vehicle that you currently are driving or actually upgrade your vehicle, go out and purchase a new asset for your business, the federal government will allow you to deduct the value of the vehicle purchase in different ways depending on weight class. So you have to know about the weight class thresholds in order to kind of dial in what write-off you're going to receive for purchasing this vehicle or buying out the lease. The vehicle has to weigh over 6,000 pounds in order for the big benefit to kick in. But if the vehicle weighs under 6,000 pounds, it's not that you get nothing as a benefit. You just get a limited deduction as a benefit on your individual business returns. If a vehicle weighs under 6,000 pounds, the first year bonus depreciation write-off that you get right out the gate is $18,200. So the car does have to be worth more than $18,200 to get that $18,200 write-off. But in the first year, if I go out and buy a nice 4-door sedan vehicle, not weighing over 6,000 pounds, my first year depreciation write-off is $18,200, and the remaining value of the vehicle is depreciated over 5 years. So it's not that you only get $18,200, you just have to depreciate the remaining value over the 5-year lifespan of the vehicle. If I go out and I purchase or pay off the lease on my Chevrolet Tahoe, a large asset, and the Tahoes qualify, Tesla Model X's qualify. I'm sure you've seen a lot more Model X's on the road. That's probably why, because of the tax benefit. The Range Rovers, the G-Wagons, the Chevy Silverados, the GMC Sierras, these large heavyweight vehicles, they weigh over 6,000 pounds. I mean, shoot, even a Chrysler minivan weighs over 6,000 pounds, which is kind of unique in that fact alone. These 6,000 pound or heavier vehicles qualify for something called 100% bonus depreciation, making the full value of the vehicle dollar for dollar deductible in the year of acquisition or date placed in service. Now that's great up through December 31st of this year, but as of January 1st of 2023, that 100% benefit doesn't go away, but it drops to an 80% deductible benefit. So you do lose 20% speed on that deduction. You lose 20% of the value as a deduction, and it has to be depreciated over the lifespan at that point, but 80% is still a heck of a write-off. So Tony, what you're telling me is if I go out and I buy a $100,000 Chevy Tahoe, weighs over 6,000 pounds, I title it, I insure it, I pay for it in correct ways under my business, that's going to give me a $100,000 write-off in this year? That's exactly what I'm telling you. Now, it won't apply to everyone because once again, you have to title, you have to insure it, you have to acquire it in specific ways to receive that benefit. But imagine this. You've got $100,000 in profit after you've written off everything under the sun under your business that is a legitimate, ordinary, and necessary write-off, and you've got $100,000 of net profit that you're basically looking at having to pay tax on. And right before the tail end of the year, let's say December 28th, you're out car shopping, you find this beautiful, Chevy Tahoe with all the bells and whistles, heated seats, navigation, all that stuff. And after all is said and done, it's $100,000. I know they're a lot cheaper, but I'm just using it as an example at $100,000. That $100,000 wipes out 100% of your profit. So it brings your $100,000 in profit down to zero. So from a federal perspective, you will owe nothing in federal income tax. The state of California does not conform to this part of the tax code, though. So California will force you to add back the $100,000 of depreciation. You still pay California state income tax on it, lucky us here in California, and the federal government will allow you to wipe out all of your net profit. In certain income brackets, I've seen people spend money on a vehicle. I'm not sending people out to buy vehicles solely for the tax write-off, by the way. I'm sending them out to make sure that if they already had that idea in the pipeline, they were already planning on buying a new vehicle. Well, let's accelerate the timetable, acquire it in this year and get that nice tax benefit for them, for the taxpayer. And sometimes I've seen 40, 50+% ROI on this deduction, meaning that a $100,000 vehicle in some situations returns them $50,000 in tax savings. But you have to be in a higher income threshold to get that 50% ROI. But you get what I'm saying. You get the gist of what we're discussing. These are massive overall adjustments to taxable income, and that 100% benefit ends as of December 31st of this year. It doesn't go away fully, but it drops to 80% as of January 1st of 2023. So if you are looking to purchase a new vehicle, or if you started talking to your spouses or your business partners about acquiring company assets, and you were thinking about doing this in first quarter of 2023, you might want to accelerate that timetable to qualify for the 100% benefit in 2022. Now, remember, it's the 6,000 pound or heavier vehicles that qualify for that 100% benefit. Vehicles that weigh under 6,000 pounds do not qualify for that 100% write-off. They only get 18,200 in the first year. There are ways to search online. In fact, I just go to Google most of the time and I type in list of 6,000 pound vehicles. And the first 50 links that pop up are lists of vehicles that qualify for the bonus depreciation rules. Or bonus depreciation deduction. So you can check that out online. If you're not looking to buy a new vehicle or buy out your leased vehicle, you're probably going to take the mileage write-off, which is roughly at about, I think, 60 cents per business mile right now, which is a great overall write-off, saves you from having to buy a new vehicle. But you want to make sure that you maximize the angles on the automotive side, the auto and truck deduction side. Have this conversation with your tax advisor. Make sure that you are approaching this deduction on your return in the correct and appropriate ways. Number 4 deduction I saw really take a kind of a turn, not so much for the worse, but just definitely a different year or different years in 2020, 2021, and 2022 from a legal and professional fee perspective. A lot of clients were losing loved ones during the pandemic. People were, starting living trusts and renewing estates or having wills drafted. People were evicting clients out of their rental properties, not so much here in California because of the moratorium, but, there was a lot going on where legal advice and professional advice was needed. So legal and professional fees also was a significant deduction in the pandemic years. Still great dollar for dollar write-offs for self-employed individuals and real estate investors. If you have solely W-2 income reported on your individual return, legal and professional fees haven't been a write-off for the W-2 employee since 2018. So for the self-employed individuals in today's webinar, the real estate investors, we're still allowed to take these deductions dollar for dollar on Form Schedule C, Schedule E, or on a corporate or LLC tax return. If you only have W-2 income, unfortunately, the form that you used to write this expense off on, it disappeared in 2018. It was called the 2106 non-reimbursed employee expense form, and that form no longer exists on the IRS side of things. But if you are solely W-2'd, I don't want you to ignore this deduction because the state of California still allows it as a write-off. So still gather these deductions for your preparer to take as a write-off, but only on the state of California side. Okay, so keep that in mind. Last but not least, number 5, and I wanted to wait for the last slide. This actually should have been number 1, but I wanted to wait till the end of the number 1 through 5 to talk about this. Bonus depreciation, aside from the vehicle purchases that we talked about, the bonus depreciation on that end, bonus depreciation has been a hot ticket item for real estate investors and real estate professionals over the past 3 years. In fact, over the past 3 years, I've filed more tax returns with accelerated bonus depreciation elections than collectively over my 19-year career. That's how hot this topic is right now. In fact, the first 2 appointments today that I've had already, we had the cost segregation conversation, and now they're in touch with Jeffrey Gann at GTG Consulting LLC here in California, here in Los Angeles County, to accelerate future year depreciation on their rental properties. Now, for those of you who don't understand this lingo, I'll try to break it down and make it as easy to understand as possible. If I buy a rental investment, let's say I buy a single family home and I'm renting it out to a family, right? And I'm collecting rental income. I have mortgage debt on the property. I have property taxes, improvements, so on and so forth. From an IRS perspective, the federal government allows you to write off any expense that pertains to that investment, right? Any repairs, insurance, utilities that you cover, plus the mortgage interest, property taxes, travel back and forth from the property, so on and so forth. So you're allowed to offset your rental income with all of those expenses. And then on top of those deductions, the federal government gives you a write-off based on the value of the building, not the value of the land, only the value of the building. So let's say that you have a $500,000 property and let's say that $400,000 is the building value and $100,000 is the land value. The federal government allows you to take the $400,000 building value and write it off over 27.5 years. 27 and a half years is the lifespan of a residential rental investment. Commercial warehouses and like the building that I'm sitting in, the Robert Hall building, this is commercial real estate. So that takes the deduction over a 39-year period, not 27 and a half. Cost segregation is an election made on the return to accelerate, not only taking the 1 year of depreciation that you get, that 27 and a half year lifespan, not only taking the 1 year of deduction for depreciation, but making an election to accelerate future year depreciation and take it as a deduction all in this year, okay? So imagine this. You've got, I'll do the calculation for you really quick. You take a $400,000 building value divided by 27 and a half years. That's going to give you a $14,545 write-off per year for the next 27 and a half years. So you have to wait 27 and a half years to get all of these write-offs, right? And you get 14,545 each year. If somebody came to you and said, well, because of your great cash flow that you have through your property, you've also got profit through your other real estate professional businesses, and you're kind of running out of steam on the deduction side, right? You've kind of spent all the money that you need. You've put money into a 401k IRA, but you're still showing positive cash flow that you're paying tax on. And a cost seg specialist or a tax preparer advises you to look into cost segregation. Imagine being able to reach forward into future years, 20 years into the future, and accelerate 10, 15, 20 years of depreciation write-off and take it all as a deduction in this year, wiping out all of your taxable income, paying no federal and state income tax at all, and with that tax savings, being able to purchase more real estate or pay off personal debt, whatever you want to do with that tax savings. Imagine that power play. Now, most people who elect to accelerate future year depreciation, they're doing it so they can pay little to no tax in this year. And with that tax savings benefit, they're buying more real estate. And then in future years, they're electing cost segregation, again, on the new properties that they're acquiring. So it's a copy and paste model in this case. But this is a probably one of the holy grails of tax shelters. And right now through December 31st for 2022, it is at 100% deductibility. Because once again, 100% bonus depreciation drops to 80% as of 2023. So I foresee in the next 2 to 3 years, probably they'll bring back the 100% bonus depreciation depending on where the economy is in that time frame, or where the economy is globally at that time frame. But bonus depreciation is a huge, a massive adjustment to your income for 2022. The craziest thing about this election is it doesn't need to be made this year. It can be made next year for the 2022 tax year. But you have to open up that conversation. We use Jeffrey Gamm with GTG Consulting LLC here in Los Angeles. He's fantastic. And what his company will do is prepare an analysis of what could potentially be accelerated from a depreciation standpoint to help reduce overall taxable income for this calendar year. That will help retain as much of the wealth as possible that you've earned for yourself under your business or personally in the 2022 tax year. And with that tax savings, I, as a tax professional, am going to push you to buy more real estate. And we're going to copy and paste this model each year. And the greatest thing about this is that you build wealth in real estate while paying very little to no income tax to Uncle Sam and the state of California. The tax side of things, like the terminology that we use in our industry, the cost segregation deduction is called a 481A adjustment. And it's not only a dollar for dollar adjustment on your IRS return, but like I mentioned a couple minutes ago, it's also a dollar for dollar adjustment to your state of California income. Once again, the holy grail of tax shelters where it hits you both on the federal side and the state side. For those of you who are veteran investors, you understand something else about depreciation, though, is that if you accelerate it this year, and let's say 5 years down the road, you decide that you want to exit out of this real estate investment. You don't want to 1031 exchange it. You just want to sell it outright, take the money and run. Depreciation was great in the year that you took it as a write-off, but if you ever dispose of that property without doing a tax-deferred exchange, guess what? You got to recapture all of that depreciation. The term is recapture, by the way. I don't know if I said that right, but you recapture the depreciation, add it back onto your return as income in the year of sale, and pay ordinary income tax on what's called depreciation recapture. So you have to plan with a tax advisor around all of this. I can tell you right now, the most consistent investment amongst my 1%ers as clients, the people who are making north of $750,000 to $1 million+ each year, the most consistent asset in their portfolio is real estate. And this is an election that those 1%ers make year in and year out. This is a massive wealth building tool. So keep that in mind as you start to invest in new properties, as you start to invest more into your current portfolio. And if you haven't bought any real estate yet, have this conversation with your tax advisor. Okay. So before we open up for Q&A, and I'll stick around to do some question and answers here in a bit. Just a couple major changes as of January 1st of 2023, solar system credits. So solar panel investments and battery backup credits, that jumps from 26%, which is the current credit you receive in 2022. It jumps to 30% as of January 1st of 2023. So we're seeing a lot of people delay the installation date to 2023 to get that 4% bump in the credit. I foresee there might be some supply chain issues in the new year because so many people are deferring their installation dates to 2023 to get that 4% bump in credit. So if you are thinking about making a solar improvement to your primary residence, to rental properties, make sure that you open up that conversation now with a solar system company and get that on the books. The bonus depreciation rules we talked about currently through the end of this year, it's 100% bonus depreciation as of January 1st of 2023. It bumps down to 80% in 2024. It drops down to 60%, 2025 to 40%, so on and so forth. And it's set to fully phase out in 2027. So we have some unique opportunities to really capture these massive write-offs in 2022 and 2023, still at 80% for next year. I do foresee that will come back, though. I don't think that it's going to basically dial out or wind down as of 2027. I think that the federal government will adjust the Inflation Reduction Act or the Internal Revenue Code to keep that benefit in place over the next 2 to 3 years. Section 1031, at the 23rd hour, the federal government decided not to change Section 1031 of the Internal Revenue Code. Thank goodness. The 1031 exchange industry provides the global economy with over 600,000 jobs, and exchanges, 1031 tax-deferred exchanges, make up for 65% of all United States real estate transactions. It is a juggernaut of an industry. And the federal government was talking about taking the no-limit exchange deferral and dropping it down to $500,000 max deferred gain for each individual taxpayer, which was changing a part of the code that's over 100 years old. Thank goodness, thanking the tax gods here, that the federal government decided at the 23rd hour not to change Section 1031 of the IRC. Just a couple interesting things. I know that everybody's been hearing about the 87,000 new employees that are being hired. Just understand that in the first quarter of 2021, kind of the middle of the road, middle of the pandemic years, first quarter of 2021, federal government employment, IRS employment dropped to an all-time low, 35,000 employees across the U.S. That might even include global employment for the Internal Revenue Service, foreign reporting and whatnot. When on average, prior to the pandemic, the federal government had, or the IRS had, anywhere between 80 and 90,000 employees on staff at any given time. So they lost a lot of employees during the pandemic. So the 87,000 new agents, in my opinion, I truly believe that they are just filling seats with butts at the moment. But even prior to the pandemic, the federal government had released an article estimating that close to 65% of their staff would be heading into full-blown government pension retirement in the year of 2026. So they had already budgeted and planned to start hiring people moving forward into 2025 and 2026. So I don't fear this new employment number with the IRS. I know that the media outlets were really pumping that 87,000 number down our throats over the past year or so. But I am not worried about that. I truly believe that the IRS lost so many employees during the pandemic that a lot of these people are just filling seats with butts. We will see over the next 2 to 3 years via case study if there is an uptick in audit ratios or percentages, see what the new focus is for the Internal Revenue Service. So we will build case study as tax advisors and advise our clients specifically as to what we're seeing, what wins under audit, what doesn't, what the main focus under the Internal Revenue Service is. If they're focusing on in-home offices or basis and assets or basis in corporations, shareholder basis, we'll look at those things and we'll advise our clients based on what we're seeing the IRS really focus on over the next couple of years. So let's go ahead and open up for questions. I'm going to end on this slide. This is the best way to contact or connect with our office. If you're a tech-savvy person, you pick up your smartphone, you text the words Robert Hall to the number 72,000. That will prompt you to sign up for a free 30-minute consultation. We suggest that you send over 2 years of tax returns prior to the appointment. Let us familiarize ourselves with your filing and with your situation. We'll check for any possible audit triggers. And most importantly, we'll add your information to our webinar email blast. These are the free educational webinars that myself and my associate Nicole, we do the webinars throughout the year. We do 140 events on a year-to-year basis. So at least if you're not looking to onboard or get advice from a new tax advisor, at least sign up for the free webinars. Once again, it's free education. And we do, just this week, I have 7 webinars this week. So we try to get as much information out to our clients and new clients, old clients, general public, as much as possible throughout the year. So let me go ahead and open up Q&A. I see some questions coming in. Oh man, Nina, I'm speaking as loud as I can. I actually turned up, I have the volume set at a higher amount. So hopefully no one else had a problem. I'm just seeing this now, Nina. I apologize. She was saying to turn up my speaker volume. I apologize for that. Hopefully you were able to figure it out on your end and increase the volume. Angela, does your vehicle need to be in your company name or can it be titled in your personal name? So great question. If you are incorporated, if you have an S Corp or a C Corporation or an LLC, in order to deduct it as a business expense, it should be titled, insured, and paid for under the EIN number and the name of the business. If you are a sole proprietor, somebody who is not incorporated as an LLC, S Corp, or a C Corporation, you can buy it personally, but you have to make sure, we talked a little bit earlier about the allocation of business versus personal use. If you are a single individual and working as a sole proprietor, non-incorporated individual, and you only have one vehicle, you have to allocate what the personal use of the vehicle is versus business use. It could be 50-50, it could be 60% business, 40% personal. Shoot, it could be 30% business, 70% personal. I doubt that that's the allocation, but have that conversation with your tax advisor. If you acquire the asset under a business, under a corporation or an LLC, that is a business asset at that point, and you might pay a little bit of a higher premium with insurance for a fleet vehicle insurance policy. But at that point, your insurance also is tax deductible because it's insuring a corporate asset. So have this conversation with your tax advisor. I think that there are a number of ways that you can title it and insure it, but only sole proprietors can acquire vehicles personally, but then they run into some of the roadblocks of what the allocation is for business and personal use. So hopefully that answered your question, Angela. Anne, can I sell my car to my S Corp and get the bonus depreciation? So once again, you can buy out a leased vehicle, but you cannot take the car that you already own in your driveway and sell it to your business. That does not qualify. But if you have a leased vehicle, you can have your corporation buy out the leased vehicle, converting that car into a depreciating asset and take the bonus depreciation at that point. But if you're talking about a car that you already own and not lease, you cannot sell that vehicle to your corporation and convert it into a bonus depreciation write-off. Unfortunately, I like where your head's at, but unfortunately, we can't do that. But then you can still depreciate the rest 20% in the years after. Yes, and another question here. Oh, did I miss? I'll come back to Girish, your question, but Anne, I think I missed your first question. But then you still can depreciate the rest 20% in the years after that, right? Yes. So if you take 80% in 2023, the 20% then depreciates over the lifespan of the asset. You don't lose that 20%. It just plays the normal depreciation rules at that point. Okay. Girish, can I sell my car to my escrow? Oh, maybe I misread the names. I think I just answered that, Girish. No, you cannot sell your car to your corporation. You can only buy out a leased vehicle and acquire that as an asset. So I did answer that. And again, how does it work for a small car that was purchased with a car loan? Can I depreciate on the regular schedule? So once again, if your vehicle is under 6,000 pounds and you've purchased it this year, you would start the depreciation schedule this year, and $18,200 of the overall cost of the vehicle would be your first year bonus depreciation. And then the remaining value of the vehicle would be depreciated over 5 years. So yes, you depreciate it on the regular schedule over 5 years, but you get that upfront $18,200 write-off because you said that it was a small car, not a large car. So now, once again, if it's bought personally and you're not buying it through a corporation, you have to allocate business versus personal use. So have that conversation with your tax advisor before you start writing it off on the return. Allison, will we get a copy recording of this? I'm in Oregon. How much of this is different in my state? Well, Oregon has some very unique state tax code. I just mentioned a couple things about California because we're based in California. But if you have specific questions about Oregon state tax, we do taxes in Oregon as well. In fact, I think just off the top of my head, I have close to 12 or 13 clients in the state of Oregon. All with real estate investments, all with small businesses. So we understand the Oregon state tax rates and code as well. The 481A adjustment, I'd have to look into that. I believe that Oregon allows it because it's a real estate related deduction, and Oregon doesn't limit a lot of real estate related deductions. And remember that the 481A adjustment through cost seg is not a depreciation write-off. It's actually an adjustment directly on the Schedule E. It only converts back to a depreciation write-off when you sell the property, and it has to be recaptured as a recaptured depreciation income source. So Allison, if you have questions specifically about Oregon taxation, we'd be more than happy to assist with that. Anita, I go in late and miss the beginning. Will this be, I believe it is being recorded. I see that that it is being recorded. So I believe that it's being uploaded to our cloud at Robert Hall. So I'll have to connect with Ronnie Marutian, who's the head of our marketing division, to see where we're going to post this. We might post it on YouTube or be able to post a link somewhere for you to rewatch it. Just understand that this is all current information now, and literally a month from now, all of this could change. So that's how the tax code is changing right now, which is crazy. Keeps me gainfully employed. I'm not complaining, but just be aware that this information will only be good for a certain period of time. But we'll see if we can make this available for you to watch at a future date. Angela, do you have to purchase the new vehicle for cash? No, that's the craziest thing about the vehicle purchase. You can finance the vehicle. Let's say you put 10 grand down on the vehicle. And it's $100,000 purchase. You take a loan on for 90 grand. You still, if that car weighs over 6,000 pounds, you still get the full 100 grand as a write-off. Bonus depreciation rise. That's the craziest part of this tax code, is that you get the bonus depreciation even though you're not buying the car outright, which is amazing. Okay. Cade, I bought a car in 2020 before I was a realtor. But I was self-employed as a caregiver. Will this qualify for a write-off? Well, if you bought the car in 2020, you would have had to write it off in 2020. You would have had to start bonus depreciation in 2020. So just be aware that unfortunately, if you didn't do that in 2020, you'd have to go back and amend that return. And I would absolutely amend the return if you did buy a vehicle as a sole proprietor in 2020 to take at least an allocation for business use in that year. Bonus depreciation was available in that year. So if I would talk with your current tax advisor about going back and amending that return, and if they're not willing to do that, maybe you on board with us and we go back and look at 2020 and file that amendment for you. So these are great write-offs. And even if you have to allocate business versus personal use, let's say we use a 50-50 split, you still get 50% of whatever that bonus depreciation write-off is. And I'm sure that if you were self-employed as a realtor and a caregiver in 2020, there probably was some tax liability that was due. Even if you got a refund, by the way, you have to look at what the government actually kept out of your refund, right? Because they usually, let's say your liability is 10 grand, you prepaid 4 grand. Or I'm sorry, let's say your refund is 10 grand, but your tax liability was 6 grand, right? That means that your total liability was $16,000 you prepaid, or maybe I'm getting calculated. Anyway, have us take a look at that because the numbers could end up playing in your favor where we get some of that money back. I was confusing myself with those numbers, but I think that that's worth looking into. Katie, I think I'm looking at the name Katie. Hopefully I'm not mispronouncing that, but I think it's worth looking into to amend that. Great, Anne. I'm glad sound is good on your end. Hi, Kristen. Good to see your name in here. It just says hi, Tony. I don't know if Kristen, if you had a question, but if you're just saying hi, good to see you in here. And the volume is perfect. Great. Can I transfer title to my company? I assume that that's about the vehicle. You could transfer title to the company, but as far as creating a new refresh depreciation write-off, because you already own the vehicle, you can't refresh the depreciation write-off under your corporation by transferring title or by purchasing it. So it really only works best when you buy out a leased vehicle and convert it into an owned asset, or when you buy a new vehicle and set up the new depreciation schedules. Could you quickly go over accelerated depreciation again? So accelerated depreciation is when you can make an election. It's called a change of accounting method, where you reach forward into future years and you accelerate 5, 10, 15, or 20-year depreciable items to take it all in one year. Any items out of a property, a rental investment, for instance, that have a depreciable lifespan under 20 years can be separated out from the 27.5-year building lifespan and fully accelerated all in the first year. I don't really know how else to explain it. It's really just the ability to take future deductions instead of waiting for them, or instead of having to wait for them, taking future year deductions all in this year and saving the money today rather than waiting 27.5 years to get that write-off. That's essentially how it works. Olivia, do I have to recapture the depreciation when I sell my investment, but the house was demolished the year before when I built the new house? So that's a great question. This is I don't want to get into too much detail and start confusing people, but let's say that the demolished house had a basis of just the building basis of 400 grand, right? And you fully depreciated that 400 grand. Then you demolished it and built $1 million home, right? And let's say the new house had a basis just in the building of $800,000, right? When we set up the new depreciation schedules, we would have to take the $400,000 depreciation amount that you've taken in past years and reduce the $800,000 new basis in the new build so that you are only depreciating the remaining $400,000 in the new asset. I don't know if that makes sense. It makes sense in my head, but we would have to apply that depreciation amount to the new asset because it, in theory, does still need to be recaptured once you sell the new investment. Just because you demolish the property doesn't negate the fact that you received a $400,000 depreciation benefit in past years. So there's a little bit of a tricky scenario there. Great question, but your accountant, or if you use Robert Hall & Associates, will know how to adjust that on your tax return. Jennifer, regarding accelerated rental depreciation, how many years of the 27.5 years can you accelerate in 1 year? So any depreciable item that can be set, and this is where Jeffrey Gann's profession comes into play here. He does an analysis of the 27.5-year building and separates out anything that has a 20-year or shorter lifespan. So whatever that amount is that through the cost seg analysis, they can separate out from 27.5 years, anything under a 20-year lifespan can be accelerated and taken all in 1 year. And there will be a portion of the 27.5-year building that's left over that still remains over 27.5 years. But the benefit here is to look at a large real estate portfolio, maybe with 4, 5, 6, 7 different properties, take into account everything that can be depreciated under 20 years for a massive 481A adjustment. And whatever you don't need, let's say it wipes out all of your income, you're paying no tax, and you're actually showing a net negative. That net negative can carry forward into next year and start offsetting income for next year as well. So you don't lose it, you just don't use it. You can only use it to offset enough to where you're not paying any tax. But to answer your question, I think you're asking what out of the 27.5 years can be actually accelerated in 1 year. That's anything that is allocated through the cost seg analysis that has a depreciation lifespan under 20 years. Okay. Trish, I currently do not have an LLC. Should I? That is a loaded question, unfortunately, Trish. I couldn't answer that question without knowing a lot more about your specific situation. That is probably more of a free consultation question. It really all depends. Not everybody should leave here thinking that they all need an LLC or an S corp or a C corporation. Incorporating is not right for everyone. That is more of a detailed kind of personal conversation you need to have with a tax advisor or an attorney. But just to give you a little bit of an answer to this, not to just say I don't want to answer it. LLCs save you nothing in tax. I do want to mention that LLCs are only for liability protection. If you are looking to get great liability protection as well as a tax benefit as a self-employed realtor, for instance, let's say you're earning commission income and you're a sole proprietor right now, you see all of this tax that you pay. If you're looking to get the benefit of both worlds, you want the liability protection for your business, but then you want all of the tax breaks that corporate America gets to receive. You can incorporate your business as an LLC and make a tax election with the IRS to file as a subchapter S corporation. Okay. So this is a great conversation to have with your tax advisor. This is something that I advise on literally on a daily basis. Same with all of the senior advisors here at Robert Hall and Associates. But once again, I need to know a lot more about the personal situation before I advise anyone to incorporate their businesses or their real estate investment properties. Unfortunately, I only have time for one more question. You guys have my contact information here on the screen. You can even scan that QR code at the bottom right part. That'll prompt you to sign up for the free consultation. Sorry, I do have a 2 p.m. kind of hard stop right now, but I will answer this last question. I own my 2016 Mercedes and have taken the mileage deduction. I don't drive nearly as much since the pandemic. I formed an LLC this past summer. Should I consider buying or leasing or just keep my current vehicle? $120,000 income if that helps. So it depends on what type of vehicle you're looking for, because, you know, in my opinion, and this is solely my opinion, not my professional opinion, but my personal opinion, living here in Southern California, that leasing is more of a lifestyle choice. You don't want the hassle of looking for a new car after 2 years. You don't really put that many miles on your vehicle. You just want to bring it in if there's anything wrong with it. You want to trade it in for a new vehicle after 2 years or 3 years, whatever that lease time frame is. So leasing, to me, it's a great lower consistent write-off for businesses. But for me, I grew up in a household where we don't rent or lease anything. We buy everything. Even a depreciating asset. We want equity. We want to own these assets. That's what I was taught by my father, my grandfather, how they were taught by their parents. So that's just something that I've kind of copied and pasted in my own life. I have a lot of clients who lease. I would suggest leasing luxury assets. Obviously, if you're driving a Porsche or a Ferrari or a Lamborghini, something, don't ever own those. That would just be the silliest thing to own. So you lease those. But if you're looking for a large upfront write-off, like a 6,000 pound vehicle write-off, that bonus depreciation, purchasing even at 120 grand of income, self-employed income, I think that purchasing would be the better overall option. Purchasing also nowadays comes with the same kind of coverage mostly as leased vehicles, mean they give you a 100,000 mile bumper to bumper warranty. Normally, BMW is great with that, by the way. I have a lot of clients who buy, the X6s and the X7s and the X8s, the larger SUVs, and take the bonus depreciation. They come with 100,000 mile warranties. Those are great for coverage. And they get this massive overall write-off. In some cases, the tax savings alone pays for your first 3 to 4 years of car payments. That's the craziest thing about the write-off. So to answer your question, this is anonymous here. I would actually consider buying, but I don't want to tell you to go out and start shopping for a car right now. I need to see a couple other pieces of information. 120K, is that your gross? Is that after expenses? If it is gross and you have 100 grand in expenses, you're only paying tax on 20 grand. So why go out and buy a vehicle when you're already in a low income bracket? So there are a lot of moving parts to the advice there. But in my personal opinion, just from a macro view, kind of a bird's eye view, purchasing is always going to be the better option from a tax deduction and tax sheltering standpoint, especially with that bonus depreciation rule still in play through the end of the year. So once again, I have a hard stop now. Thank you so much for logging in. I hope you enjoyed today's webinar. Reach out to our office, on board with us if need be. If you're not looking for a new tax advisor, at least sign up for the free webinars. This is just such a powerful tool for self-employed individuals, for real estate investors to have. All of our education is free. Nicole is a great public speaker. I'm the other public speaker for our firm. I love what I do. I love educating people about what I do. It is a confusing part of the financial world. If the tax code was easy, I wouldn't have a job. Let's just put it that way. So we try to keep up to date with as much information as possible. We try to give you the most up-to-date information possible. But once again, this webinar might be out of date in the next month, 2 months. So this is the best way to sign up for that webinar, eBlast. And we look forward to speaking with you in the future months. Everybody have a great holiday, great end of the year. Keep crushing it. Stay safe out there, and we'll see you soon. Take care.